Good morning and welcome to another live technical analysis. We're going to be starting off with the euro against the US dollar. So, in terms of price action, it appears to have broken our upwards moving trend line, which was incepted roughly on the 3rd, on the 29th of February. Actually, no, on the 1st of March. So, upwards moving trend line validated on three occasions. So, one, a second touch, and then let's say a third, broken. So, we would not maintain a bullish outlook for the particular pair. Now, the potential attribution to the weakening of the euro could be in part to the US CPI rates, which came out yesterday. So, we had noted this in yesterday's live technical analysis, in which we said, should the CPI rates imply persistent inflationary pressures that could weigh on the market optimism of potential rate cuts by the Fed, et cetera, potentially providing some support for the greenback. So the CPI rates, let's take them core and headline CPI. So core came in higher than expected, yet implied easing inflation pressures overall, but still persistent in the economy. Headline actually accelerated on a year-on-year level. So, good morning. So, persistent inflationary pressures in the US economy. Now, we also noted that we are in the FOMC's blackout period. Now, the blackout period means that we won't be having any Fed speakers up until their decision. So, based on that, we are seeing the market reaction. Now, if I'm not mistaken, following the release at, let's see, right here, 230, yes, 230. So you can see that the dollar strengthened, yet since then it appears to have lost its gain. So it came lower and has stabilized later on. Now, we could attribute this to a few things. One, the market expectations of a June rate cut by the Fed remained intact. So even though the CPI rates came in higher than expected, which provided some support for the dollar on the chart, as you saw, overall, the expectations of a cut beginning from June does not appear to have changed, so potentially weakening the dollar. Furthermore, we note that the expectations of four rate cuts have now diminished to three by the market, which appears to be in line with the Fed's dot plot. So for now, we saw a slight strengthening of the dollar. Overall, I would expect it to move in a sideways motion for the rest of the day. You can see the narrowing of the Bollinger Bands, the breaking below our upwards moving trend line, RSI running along the figure of 53, so close to 50, implying a neutral market sentiment. So the pair staying between S1 and R1 would not be surprising for the rest of the day, as today's financial releases are weak from the US side. Tomorrow, that's a different story. We have retail sales rate, PPI, which could influence the greenback. As such, we're maintaining a neutral outlook for today between S1 and R1 for those aforementioned reasons. No reason to change our support and resistance levels just yet, as it appears to be staying between S1 and R1. Moving on to the dollar against the Japanese yen. Now, here we may have seen a more evident strengthening of the US dollar. And why am I saying a more strengthening of the US dollar? Well, if you take the comments made earlier on by BOJ policymakers, which is something that we have been reiterating for the past month or so, they could have been perceived as hawkish in nature. According to an FT headline, auto workers received one of their largest pay increases, which appears to be in line with the BOJ's implied requirement for an abandonment of the rule-to-loose monetary policy. So the BOJ wants to see inflation within the target remaining there sustainably. Furthermore, they want to see an increase in real wages. So if you have an increase in real wages and CPI appears to be in line with the bank's inflation targets, well, that would give more reason for the BOJ to potentially abandon the rule to lose monetary policy. So I'm going to be making a prediction from my own personal view for the BOJ's meeting, which is due to occur next week. Now, personally, I think that the BOJ is going to remain on hold, but it's going to be more hawkish than usual. So I'm expecting the JPY to potentially strengthen following the bank's interest rate decision. For now, it looked as if it was moving in a sideways fashion. You can see there's a leg up, came back down, so higher highs, higher lows. Now, for a higher high, this would actually need to close, let's say, on R1, which is now S1, and then move higher. So higher highs and higher lows could imply a bullish outlook for the pair. which is surprising considering the aforementioned reasons in terms of the potential abandonment of the bank's ultra loose monetary policy. I'd like to also add volume on this chart. So, relatively low volume in comparison prior data. Okay. Overall, we can see a downward trend in volume. Let's just show this. Oh, no. I want this trend line. So you can see decreasing of volume. So I wouldn't be surprised if this moves lower. So slightly red candle and then lower and lower and lower. And then potentially aiming down for S1. So let's just remove this now, make our chart look slightly nicer. So that's a fundamental point of view. From a technical, you could be bullish. You have an upwards moving trend line validated on 4, if not 5 occasions, so making that a valid upwards moving trend line. RSI is back at 53, so it's moving higher and higher, implying that the bulls may be taking over the particular pair. It's also broken above resistance, now turned to support at 147.75. As such, from a technical point of view, we would be, I'd say, slightly bullish for the particular pair, as long as it breaks above new R1, which is very far away. So, bullish, that's very relative. Instead, I'd like to see it test S1, make sure that this is resistance turned to support, and then stay between S1 and R1. I wouldn't be that bullish in terms of it breaking R1. As a matter of fact, I'd actually have to bring R1 lower. So now this is a different story. With R1 slightly lower, one could say if it does break above R1, we might be bullish. I'm bringing R2 to the swing low here, as this would be far too high. And then I'm simply placing R3 above R2. If it manages to break above R2, then yes, we would switch for a bullish outlook. If it breaks above R1, we could also switch for a bullish outlook as long as it aims for R2. So let's just fix our support and resistance labels real quick. 149.78. Not 149, 149.78. So this could be R2. For R3, we could do 150.82, rounding that up, rounding that down. 150.80. So R3. Then you have R2, 149.78, which could actually be 80 as well, but I just like to keep it on the candles rather than slightly above or below. R1, we could say 148.60, rounding that up. See 148.60. So that's R1. So if it does break above R1, slightly bullish, but from a fundamental point of view, I've already explained as to why I would be trying to see a more hawkish BOJ. But for now, technical point of view, if it breaks above R1, bullish. If it breaks above R2 as well, if it fails to break above R1, sideways between S1 and R1. If it breaks below S1, bearish as long as it manages to reach back down to S2. Old S1 becomes S2, old S2 becomes S3. And we can keep that line for future reference as the S1 level is fairly close to the price action. As such, tomorrow we might need to readjust our support and resistance levels. Now we're going to be looking at gold. If you saw and were with us yesterday during the live, you'll probably remember that I said I would like to see it move lower before moving higher, and it have been the case. Now, for now, technical point of view, upwards moving trend line, bullish as long as it manages to break above R1. RSI at 50 might imply slightly sideways bias. Now, this is what I'd like to see. I'd like it come back down in this 4-hour candle, rest on S1, validating this as support before moving higher back to R1. Now, if it does close in this 4-hour candle above the upwards moving trend line, still bullish if it manages to break above R1. If it does not, sideways. If it breaks below S1 and moves to S2, bearish. You can see the targets S3, S2, R1, and R2 and R3. So in terms of the pound, This was the support and resistance levels that we had placed yesterday. Note how it is resting on 1.2775. So finding some support. I would not be bullish, and this is why. Pierce below could also imply that the bears may be taking over the pair's direction. Uh, the narrowing of the Bollinger Bands implies some low market volatility. RSI is close to 50, so we could maintain a sideways bias as long as this 4-hour candle does not close below S1. If it closes above S1, sideways between S1 and R1, whereas if it closes below, bearish immediately, taking aim for S2. Next potential target being S3, 1.2615. Moving on to gold. Now, this is what we were saying in yesterday's live technical analysis. I'd like to see it move lower, back down to S1, validate this as support before continuing on its ascent. I would not draw an upwards moving trend line as the angle is far too steep. RSI at 73. So it's the scenario we described yesterday, in which the RSI remains strong, yet we see a market correction down to lower ground before it continues on its ascent. So the bulls appear to be still in control. This could be a market correction down to S1 before moving higher. If it manages to break below S1, switching for a bearish outlook, breaks below S2, next target could be S3. If it comes back down to S1 as we would like it to occur, find support and then move higher and pierce R1, we would maintain a bullish outlook for the particular pair. From a more macro view, I would be bullish on the precious metal for the geopolitical risks that we mentioned yesterday. We have uh, essentially numerous conflicts occurring. There's a high risk of other conflicts occurring on a geopolitical level across the world as well. Tensions, uncertainty, etc., etc. All could funnel safe haven inflows into the precious metal. So for a bullish outlook, has to break above R1, taking aim for R2. If it manages to break below S1, bearish outlook down to S2. If it fails to break above R1, so comes back down. So let's say two more candles, touches on S1, then makes a few small ones. So relatively this size here instead of this one here. I would maintain a sideways bias between S1 and R1. Oil, sideways direction between S1 and R1. Note the narrowing of the Bollinger Bands, the RSI. CCI above 100 comes back down. We might see it staying between S1 and R1. This would be interesting to look at as well. But for now, sideways between S1 and R1. You could even start to note a sideways. No, this is Fibonacci. Sideways moving channel. Let's say from here, overbought, came back down, and now continues between 76.85 and 79.05. So essentially implying a neutral market sentiment for the commodity. Moving on to the Aussie. So essentially, we're seeing that the dollar overall strengthened. You can see resting on S1, sideways bias between S1 and R1, narrowing of the Bollinger Bands are side 52, implying a neutral market sentiment. Aussie could also be dictated from news stemming from China, given their close economic ties. So if you see any news regarding China and their economic outlook, you could look at the Aussie and see how that reacts as well. Dollar CAD. Now, the Canadian dollar, if oil were strengthening, we may have seen the loonie also strengthening as well. For now, it appears that the US dollar is in control. RSI 50 as well, sideways, narrowing of the Bollinger Bands, crossover, neutral market sentiment, sideways between S1 and R1, nothing too major. Now, given that we don't have really anything major from the US today, and most of the action might be tomorrow with the core retail sales rate and the PPI, we might see most pairs uh, moving in a relatively sideways fashion. So relatively low volatility today, staying between S1 and R1, breaks above R1, target being R2, breaks below S1, target being S2. We'll have a look at the Dow Jones in just a moment. So as we've said, upwards moving trend line, and we could actually even draw. Let's see if we can draw an upwards moving channel as well. So you have two touches. Let's see. Let's just bring this here. Overall upwards moving trend line as well. I'm just bringing it back down so that this is easier to see. You could say it's moving in an upwards moving channel. So bullish RSI remains steady near 70, implying a bullish outlook for the S&P 500 index. But we would like to see it break above R1, take aim for R2. So 5,250 for R1, 5,400 for R2. If it breaks below S1, switch towards a bearish outlook as it would coincide with the breaking below the upwards moving trend line and upwards moving channel, implying a shift, potentially sideways or bearish. If it closes below S1, bearish, taking aim for S2. Nasdaq 100. Now it stayed within this very tight range that we had placed yesterday, so 18K and 18.425. So we could maintain a slightly neutral outlook for the Nasdaq if it stays within S1 and R1. But note, it still continues to validate our upwards moving trend line, which could imply some bullish tendencies remaining in the index. Also, our size at 60. So once again, some bullish tendencies, but it is meeting a heavy resistance at R1. Our favorite airline manufacturer, Boeing, broken below S1, still maintaining a bearish outlook on the company stock price. For those of you that were not here yesterday, essentially news stemming regarding Boeing's production standards, the grand jury assignment over the weekend and yesterday, on Monday. Negative market sentiment could be weighing on the company's stock price as well. You have had about 2 or 3 airplanes that reported technical difficulties, and those planes were manufactured by Boeing, which could be further adding to the negative sentiment surrounding the company. In terms of technical analysis, RSI well below 30, it's at 23 now, implying strong bearish market tendencies, broken below support now turned to resistance, bearish outlook, fundamental and a technical point of view. Widening of the Bollinger Bands imply high market volatility as well. So overall, maintaining a bearish outlook for the company's stock price. Let's take this high. So you have a bullish candle validated on 3 occasions. So taking the open, wicked, then strong movement higher. So this may have been a prior support level, also coinciding with a nice figure, 141.50. Let's make the RSI smaller. So I have R1, R2, R3. Now this becomes S3, 141.50. Overall, bearish outlook for the company stock price for the reasons we mentioned before. Moving on to Nvidia, recouped swing low. Okay, so higher highs, higher lows, bullish for the company stock price potentially. So this may have been a market correction. Note that the Bollinger Band, the mid-range, is coming up and up to our S1 level. Overall, we would be bullish for the company stock price. In terms of the RSI, 71, strong bullish market sentiment. Bollinger Bands appear to be tilted towards the upside. If we extend our upwards moving trend line, bullish, so you have an upwards moving trend line. The Bollinger Bands, the higher lows and higher highs, RSI, all point towards a bullish outlook for the company stock price. But for it to continue from a more macro level, it would have to break above R1. If it does not, sideways between S1 and R1. The case for a bearish outlook, I do not see as of now. But if it does break below S1, we could switch for a bearish outlook and then taking aim for S2 at 746.10. Now, what else are we going to be looking at today? So we haven't really done the Dow Jones 30. I think we just need a slight correction or adjustment on our resistance level. It wasn't 39k 140, so 39,140 for R1 instead of 39,000 might be a bit more prudent. You could say that it's relatively bullish, like we could draw an upwards moving trend line from here as well. It's not that steep, so it might be more sustained in terms of a move. RSI at 61, so some bullish tendencies remain within the index. Let's just fix this. 39k 140, but it has to break above R1 for our bullish outlook to continue. If it simply stays below R1, I wouldn't be bullish. I'd be neutral between S1 and R1. But if it does manage to break above R1 after failing on 2 occasions, then yes, bullish outlook for the Dow Jones 30, potentially taking aim for the potential resistance at 40,000. So we've done 1, 2, 3. We've done major pairs as well. Then last time we've done Boeing, Nvidia, Netflix. We can have a look at just a moment. One could say this was a symmetrical triangle broken down, bearish for Apple stock price. Tesla still sideways between S1 and R1. It's resting on our old S1 level. Might need a bit of a correction slightly lower, so 174.75. So about $1 lower than what we had previously. So readjusting our support level. It's not a breaking below support turned to resistance because it bounced back up. So simply put, so S1 should have been slightly lower. So still sideways. But the RSI is at 36, so it does imply strong bearish tendencies for the company stock price. Let's also add the Bollinger Bands. There we go. Okay. Macro, you could be bearish for the company stock price. Look at the moving averages, slightly tilted towards the downside. RSI has to break below S1 and move to S2. As we said before, S1 needs a small correction. If it breaks below and aims for S2, then we would be bearish. For now, slight bearish tendencies appear to be remaining within the company stock price, but not definitive in my personal view. Airbus moving higher makes sense. Boeing, your competitor, is moving lower. So look at Boeing, look at Airbus. For our time frame, it's gaining. Now, if Airbus wasn't that backlogged in terms of aircraft orders, I would have expected it to move much higher. So we've done Nvidia. We'll actually have a look in Airbus in a few minutes. We'll look at Apple as well. ExxonMobil appears to continue moving in an upwards fashion. Upwards moving trend line. Bollinger Band is looking towards the upside, aiming for the upper Bollinger Band. RSI at 64 implies bullish tendencies, but it has to break above R1 for our bullish outlook to continue. But it could come back down to the upwards moving trend line, correct, which would coincide with the mid range of the Bollinger Bands and then move higher. So for a sideways bias, it would have to pierce through or break below the upwards moving trend line and fail to break below S1. If it breaks below S1, bearish. If it comes back down and then moves higher, still maintaining a bullish outlook for the company's stock price. Let's see what else we have. Norwegian krona might be slightly bullish. Crossover might be a bit bullish as well. 60, but overall might be losing some momentum if it fails to break above R1. BP. Okay, sideways bias between S1 and R1. 468.10, 485.15. Ferrari. Sideways bias between S1 and R1. Same between this range. RSI, that's 62 implying some bullish tendencies, but overall I'd maintain a sideways bias for the company stock price. Bank of America is actually moving higher, bullish. Let's see what happens with the CRE discussion in the United States, which is the commercial real estate loans, which appear to be a bit of a concern recently. Google appears to have recovered following the, I'd say, negative sentiment and news coverage of their uh, Gemini AI, if I'm not mistaken. Above S1, I wouldn't be that bullish on the company. RSI 53 just broke above S1, sideways between R1 and S1. Note narrowing of the plunge bands, implying low market volatility. Coca Cola as well wouldn't be bullish, neither bearish. RSI at 59, so it's still close to 50, so neutral market sentiment. Now, what we could do is simply bring S1 slightly higher, so 59.20. 9.20, 57.55 for S2, 56.12 for S3. Resistance levels remaining the same. For a bullish or bearish outlook, it will have to break above R1 or below S1 respectively, but that does not seem to be the case yet. Going back, so we've done ExxonMobil, we could do IBM, and unless there's something in particular you would like to look at together. Until then, I'll be looking at Apple, broken below S1, taking aim for S2, which is now S1. RSI 34, so it was oversold, corrected, might continue in its descent. One could say this was a symmetrical triangle, broke down below 3%, so potentially validating this. Bullish outlook would simply have to break above R1, taking aim for R2 at 195.30. Just add some text labels as well. Swan 166.80. S2 155. And then before we move on to the resistance levels, let's find S3. Note this is the daily chart. So what we're looking for is areas of heavy support or resistance turned to support. One of them could be 144.35. But let's look at this price action here as well. And let's measure the distance between S1 and S2. 117 ticks. 17. Oh, must be wrong. So 1,115. So somewhere around here would be optimal. Taking the swing low, maintaining a roughly equal distance between the support levels as well. 144.35 for S3. Now, you may be wondering that the coverage for Apple's VR headset has been, I'd say, positive. So there's been a lot of marketing going on. But the issue with Apple is that its sales are dropping in China. And that makes, I believe that could impact the revenue, which appears to be also the market's expectation as well, potentially weighing on the company's stock price. So essentially, lower sales in China and gloomy economic outlook for China could weigh on future revenue, and as such could weigh on the company's stock price, which is why we might be seeing Apple move in a relatively downwards direction. 95.30, then 212.20, and that would be Apple. So this is R1, R2, and R3. Bearish outlook for the company's stock price from a technical point of view. RSI breaking below, but it will have to break below S1 of 166.80 for that outlook to continue. IBM. Let's clear the chart. Daily, we could go into a 4-hour chart as well. I mean, why not? 4-hour support, swing low, hold high, coinciding with the closing of this bearish candle, 191.60. So that's my S1, S2, low low, 179.60. And then for S3, the point at which the breakaway gap occurred, one continuation gap, and then we may have seen an exhaustion gap. Nonetheless, under 66.70, that would be my S3. We'll fix the text labels in a few moments. Now, in terms of resistance, is this all-time highs, or at least the data we have? Yes. So, as usual, in the scenario where we have to formulate potential resistance levels, all-time high figure, 199.10, potential resistance. And then we simply measure the distance between S1 and S2, S2 and S3, and then we extrapolate that and reflect it higher in order to find potential resistance levels. So 1,208. 211.10 potential R2, turn 23.50. That's the distance between 25.10. That's the distance between R1 and R2, and then reflecting that to R2 and R3. And now we need to fix our text labels. Overall, technical point of view, RSI 63, implying some bullish tendencies. Moved in a relatively sideways fashion up until this point. Moving higher, upwards moving trend line would be maintaining a bullish outlook for IBM as well, if it manages to break above R1. If it does not, sideways. If it does not break that today, maintaining a sideways bias for the company stock price, as it might appear that the bullish momentum may be fading away. And this is R1. This is R2, and then R3, 225.10. And to 1.60, 176.60, and 179.60 for S2, and then 166.70 for S3. So this was IBM. Tesla we've done, Apple we've done. Netflix, I wouldn't pay that much attention. I'd focus more on NVIDIA, Airbus, which we said we're actually going to do, and Boeing. Boeing is interesting. So I'm placing S1. Note the multiple touches. So it found heavy support at this level, or so that is implied by the price action. So it backed down, came back up, tried again, came back up, managed to pierce through, yet the bulls took over, pushed it higher. RSI 67, so stronger indication than other charts in terms of RSI. And since 159, if we round this up, and since it's already higher, appears to be moving higher. If it manages to break above R1, bullish outlook. We could even draw an upwards moving trend line stemming from roughly the 13th or 15th of February. Here it was moving relatively sideways. So if it does not break above R1, sideways bias between S1 and R1, manages to break above R1, bullish outlook, and we'll figure out where R2 and R3 is in just a moment. So that's S1. S2, I'm looking at these three candles. It wicked, bearish, failed, and then moved higher. So heavy support pressure. And then at the beginning of this move, this point here, you have three candles, failed to break above, and then rapidly moved higher. So bulls potentially at this point, 147.65, 152, rounding it up, 152.00, 156.30. And if this is an all, yes, it is. So we do the same as we did before, extrapolating the distance between support levels and then reflecting them higher. 436. $163.30. Distance between R1 and R2, 413. $167.35. So I have R1, R2, and R3. This is probably going to be the last chart of the day. 24, and that's 167.35. We'll add another indicator just before we close, just to see that we have a predominant, actually just for us, let's just see if our hypothesis appears to be correct. We'll look at these tomorrow as well. So same time, same place. We'll have a look. We'll talk about tomorrow's financial releases. In terms of today, it's a relatively easygoing day. Nothing too major or that significant. I place more emphasis on the aftermath of the CPI rates from yesterday. If you have access to Bloomberg, that may be interesting to watch. See some interviews, discussions. For today, I place more emphasis on FX pairs, perhaps gold and oil. In terms of geopolitics, that always could potentially influence the market. So developments on that might be interesting, but nothing too major. I'd say it's a relatively easygoing day, with the exception if we see more comments by BOJ policymakers. But for now, RSI 67, upwards moving trend line, has to break above R1 for a bullish outlook for Airbus. Take aim for R2. If it breaks below S1, switch for a bearish outlook. If it breaks below the upwards moving trend line, as it could potentially move towards S2, next target potentially being S3. And with that, I think we are done for the day. I'll see you tomorrow. Have a wonderful day. And that's it. Goodbye.
right, okay, before we kick things off, let's quickly go through the risk warning and disclaimer as well. Do take note that all the products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. Right? These products may not be suitable for everyone, and you should ensure that you understand the risk involved. All right, do take note of the disclaimer as well. The information in this webinar should not be considered investment advice or investment recommendation, but instead educational material only. All right, so my name is Ketan Ramachandra. I'm an investment analyst here at Everest Fortune Group. So this webinar series is brought to you in a special partnership between IronFX and Everest Fortune Group, where we have been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. All right, so today's webinar series will be the first part of the Fibonacci series. So we'll be looking at retracements. So we'll start off with the basics, of course. We'll look at how do we identify an ideal market structure? How is it different from something that's non-ideal? Why is that important? Because when we are trying to use the Fibonacci retracement tool, we should be looking for ideal market structure or something that resembles as closely as possible to an ideal market, right? Being the real life world, nothing's ever ideal when it comes to market structure or price action, but we are going to look for something that's going to be as close as possible to the ideal structure. Then we will look at how we can follow the market structure so as to achieve good or to achieve significant Fibonacci retracement levels, right? When we do not use the Fibonacci retracement tool correctly, and when we do not follow the market structure as closely as possible, then the retracement levels that are highlighted by the Fibonacci retracement tool will not indicate significant resistance or support levels, right? So that's the basics. We are going to identify what is an ideal market structure, what type of price structure in reality mimics the ideal market structure, and then how to follow that, and how do we draw the Fibonacci retracement from the starting point to the end point. Then we'll also look at the various Fibonacci retracement levels. Then we'll also touch on the negative Fibonacci levels as well as the levels that are greater than 100%. All right, so if you have any questions along the way, do not hesitate to drop your questions in the Q&A box or the chat box. I'll be more than happy to go through your questions should there be any doubts along the way. All right, so let's start off with the ideal market structure. What is an ideal market structure? Well, first of all, we'll start off by looking at what is wrong, right? Okay, so when we are trying to draw a Fibonacci retracement, we're looking for significant swings, right? So we're looking for market swings, so like a swing high or a swing low, right? In this example here, what we are seeing, this GIF is showing us an example of insignificant swings, right? So you can see here, I'll just label it, this is number one, this is number two, right? So swings like these are pretty insignificant, right? And also here, looking at here, 3, this is a swing high, 4 and 5, right? When you look at 1, 2, or even this one here, let's label this 6. You can see this swings, all these swing highs here, these are the highs, they're all pretty insignificant. So we're not looking for these sort of insignificant swing highs, right? Similarly, when we look for the swing lows, you look here, A, B, C, D, right? These are insignificant swing lows, right? So we're not looking for this type of market structure where the swing highs and swing lows are insignificant. This is pretty noisy, right? To a certain extent. So what we're looking for in a market structure that will have significant swings. Now, this can be swing highs and swing lows, of course, right? So now that we've had an example of what is or what are insignificant swings, let's move on and try and see how do significant swings actually look like, right? Okay, now here we have a GIF showing us examples of how to identify significant swing highs and significant swing lows, right? As you can see here, we need to look for significant swing highs and lows. So clearly we can see here, point number 1 is a significant swing high. Point number 2 here is a significant swing low. Point 3 is another significant swing high. Point 4 is another significant swing low. Point 5 is a high. 6 is a low. 7 is another high, right? So this GIF is clearly illustrating how do we identify significant swing highs and lows in market structure, right? So you can clearly see this is a swing high here, 0.1. This is a low, high. Number 4 is a low, 5 is a high again, 6 is another low, and 7 is a high, right? So do take note. This is how, this is a type of market structure that we're typically looking for when we're trying to identify swing highs and swing lows, because that's very important. That's basically the main foundation of Fibonacci retracements. We need to identify the significant swing highs and swing lows so that when we actually use the retracement tool and we draw the Fibonacci retracements, we are going to get retracement levels that would actually function as, or that would potentially function as very significant resistance or support levels, right? So what we're trying to do is increase the probability of these retracement levels functioning as a significant support or resistance, right? If you don't draw the Fibonacci retracement in the correct manner, the subsequent retracement levels are very likely not to yield any significance, right? Be it as a support or resistance, okay? Right. Now, how do we follow the market structure, right? Now that we've identified significant swings, highs and lows, now how do we identify, how do we follow the market structure when we use the Fibonacci retracement tool? So as we can see in this GIF here, 0.1 is clearly a significant swing low. That's fine. That's great. 0.2 is also a significant swing high. 0.3 is another significant swing low. And 0.4 is another significant swing high. But in this example, they're drawing the Fibonacci retracement starting from 0.1, but going all the way up to 0.4. As you can see here, the highlighted diagonal line, right? You can see the highlighted diagonal line is going to come up again. Now that highlighted diagonal line in blue, that is the trend line of the Fibonacci retracement tool, right? Fibonacci retracement tool. So when we start Fibonacci retracement, we always start from the left to the right. So when we're doing it for the upward part of the move, we're always going from bottom left to top right. Similarly, when we draw the Fibonacci retracement for the downward move, we're going to go from top left to bottom right. So do take note, this is another key aspect of how to use the Fibonacci retracement tool. We always go from left to right. So if it's an uptrend, if market structure is going up, right, we always go from 0.1 on the bottom left to 0.2 on the top right. Similarly, when we have a market structure that's showing a strong downturn, we're going to go from 0.3 to 0.4. That means we're going to go from top left to bottom right. Remember, Fibonacci is always left to right. Yeah. Whenever we are drawing the Fibonacci retracement tool, be it for the upward move or the downward move, we always go from left to right. So for the upward move, for the uptrend, we're going to go from bottom left to top right. And for the downtrend, we're going to go from top left to bottom right. Okay, that's another key aspect of using the Fibonacci retracement tool. All right, now going back to that trend line, remember I was talking about that can you see here, this highlighted in blue, this trend line. Now in this example, they've started this Fibonacci retracement starting from 0.1 and ending it at 0.4. We can clearly see that the trend line is not capturing the market structure at all, right? We can see that there's plenty of gaps to the top of the trend line as well as to the bottom of the trend line. So in this type of market structure, the ideal Fibonacci retracement, right, to be drawn would be from 0.1 to 0.2. So when we draw it from 0.1 to 0.2, we can see that the trend line will capture the market structure much better than from 0.1 to 0.4. Similarly, when we're doing it for the downtrend, we'll start from 0.2 to 0.3. And when we do that, the trend line will capture the market structure very closely. So that's what we're looking for. We're looking for the trend line to capture the market structure as closely as possible, be it to the upside or to the downside. So that's how we know whether we've drawn the Fibonacci retracement using this correct starting and ending points. Do take note, if the trend line does not capture the market structure very well, that means it's quite likely we have not used the ideal starting and end points for the Fibonacci retracement. right? Okay, let's go on to the next slide. Now here, we can see we've identified point 1 and point 2. Point 1 is the starting trend, starting point. Point 2 is ending point. And you can clearly see that the blue trend line has captured the market structure as closely as possible. Of course, there are going to be a little bit of gaps to the downside and to the up of the trend line, but in general, we can see that this trend line has captured the market structure very well. Now, similarly, if we had drawn the Fibonacci retracement from point 0 to point 1 here, right, we would have seen that the trend line would have captured this market structure very well as well, right? Would have captured this market structure pretty well, right? So this is what we are trying to emphasize and highlight. So be it for an uptrend or a downtrend, Fibonacci retracements, we always go from left to right. For the uptrend, so bottom left to top right. And for the downtrend, we start the retracement from the bottom top left and we end at the bottom right. Right. And the other aspect to take note of, or the important point to take note of, is the trend line must capture the market structure as closely as possible, be it to the downside or to the upside. All right. All right, great. Okay, let's move on to the next slide. All right, so now that we've had a quick look of how we can, of how to identify ideal market structure, how to identify significant swing highs and swing lows, and also we've also seen how to draw the Fibonacci retracement in a manner that is going to give us significant retracement levels, right? We saw we have to start, we have to identify significant swing lows here. You can see point 0 is a significant swing low, point 1 is a significant swing high, and point 2 is another significant swing low. And similarly, when we choose the most ideal starting and end points, the blue trend line is very likely going to capture the market structure very closely, right? So do take note of that. All right, okay, with that, now we're going to look at the various Fibonacci retracement levels. Okay, for those of you who may be aware or have used the Fibonacci retracement tool before, so we know that this goes from 0 to 100, right? 0 to 100%. Right, so the retracement levels, as highlighted here, as you can see, or well, not highlighted, but as described in this image, you can see that the retracement levels run from 0% to 100%, right? So the key retracement levels are at 23%, 38.2%, 50%, the golden ratio of 61.8%, and the 78.6%. So there's 1, 2, 3, 4, 5 key retracement levels, right? So when we talk about the Fibonacci retracement levels, we're talking about the 5 key retracement levels running from 0 to 100, and they are, right, 23%, 23.6% to be precise, right? 38.2%, 50%, 61.8, which is the golden ratio, of course, and we end up with 78.6%, right? So do take note, these are the 5 key retracement levels: 1, 2, 3, 4, 5. 23.6%, 38.2%, 50%, the golden ratio 61.8%, and of course the 78.6%. Now, in this example, we have started this retracement from point 1, the starting point 1, right? And the ending point 2. So do take note, Fibonacci retrace, the starting point of the Fibonacci retracement will always indicate 100%, and the ending point will indicate 0%. So conversely, if I were to draw the Fibonacci retracement from this part here, let's just identify this swing low as 0.4. Now, let me just tidy this up a little bit. Right, let's just identify this swing low as 0.3 and this swing high as 0.4. So when I draw the Fibonacci retracement starting from 0.3 to 0.4, my starting point is going to show me 100%, and the ending point is going to show me 0%, right? Just like how we see here on this downtrend, right? On the downtrend, we start from top left and we end at bottom right. Conversely, for the uptrend, we start at bottom left and we end at the top right. So starting point is always 100% and ending point is 0%, right? And the key retracement levels, like I said, are the 5 key retracement levels at 23.6%, 38.2%, 50%, 61.8%, and 78.6%. Now, in this example, we're also showing Fibonacci levels that are greater than 100% and lower than 0%, right? So the negative retracement levels are the key retracement levels at the negative point are negative 27.2 and negative 61.8%. We'll touch on this a little later. Similarly, extension levels that are greater, Fibonacci levels that are greater than 100%, the key levels are at 127.2% as seen here, and what is not seen is at 161.8. But for now, let's just focus on the retracements, right? So 23 to 78.6, right? So as I mentioned, we started at 0.1. We started this retracement, right? We started this retracement at 0.1, 100%, and we end at 0.2, which is 0%, right? So we can only start this once the price has formed the swing low. So basically, we're waiting for price to make this significant swing low here, come up here, maybe the first after the first 1 or 2 candles or 3 candles, depending on your time frame. Let's just assume we are on the 4-hour time frame and we see 2-3 candles, at least 1 or 2 candles being formed after we see the significant swing low. That's when we can draw the retracement. So in this case, we're drawing the retracement from 0.1 to 0.2, and what the subsequent retracement levels at 23, 38, 50, 61, and 78.6, what these levels are going to highlight. These levels are what these levels are going to highlight are potential resistance levels. Do take note when we draw the Fibonacci retracement for a downtrend like this, the subsequent retracement levels are going to help us identify potential resistance levels. All right. Conversely, when we draw the Fibonacci retracement for the uptrend, right, we're going to start from 100% and at 0. What the subsequent retracement levels tells us is going to highlight to us is our potential support levels, right? So we get 23.6%, 38.2%, 50%. So for the uptrend, the retracement levels are going to highlight potential support levels. And for the downtrend, the retracement levels are going to highlight potential resistance levels, okay? Right. So as you can see here in this example, 23.6% didn't offer much resistance, right? You could see price just stalling briefly here before going higher, where it does seem to have run into resistance. Okay, then after that 38.2%, we can clearly see price breaking above 38.2% as well, where price failed to break above is at the 50% retracement, right? Clearly, we can see here price has failed to break above the 50% retracement. So this is a major resistance for price in this current example. So we can see just because we have a retracement level at 23.6% and 38.2% does not mean that price is going to stall at this level and reverse and drop lower, right? They are just points that are going to help us identify potential, right? What is important here, they are highlighting potential resistance levels. It doesn't mean that they will act as significant resistance levels, but what the retracement levels here are going to highlight is they're highlighting potential resistance levels. So, but in this example, you can clearly see 23.6% and 38.2% did not offer any major significant resistance, where price did stall was under the 50%. So now we know for that 50% is a significant resistance level and is going to take something pretty like a strong catalyst for price to break above this level. All right, so do take note. The retracement levels highlight potential support or resistance. They do not indicate or they do not guarantee that these retracement levels are going to function as very significant support or resistances, right? Do take note. That's a very important, another important aspect of using the Fibonacci retracement tool. All right, okay. Moving on. All right. As I mentioned, the key retracement levels are 23, 38, 50, 61, and 78. Levels that are lower than 0. We also have Fibonacci levels that are lower than 0%. And we have Fibonacci levels that are higher than 100%. So we're going to get to those as well. All right, so the negative Fibonacci levels, right? So the negative Fibonacci levels are also known as expansion levels. You can see Fibonacci, the key negative Fibonacci levels are negative 27% and negative 61.8%, right? These levels, these negative levels are also known as expansion levels, all right? So you may hear or come across this term, so do not be confused if you come across the term Fibonacci expansion or expansion levels, right? They simply refer to the negative retracement of negative levels, which are at negative 27.2 and negative 61.8. All right. Okay. So these are the key retracement levels for the negative at the negative end, and they are also known as expansion levels. Now, how can we use this? Okay. Uh, how can we use these expansion levels? Well, first, right, you can see we started this retracement from point 1 here, and we ended at point 2, right? And we can also see 50% is here. So in order to use the negative levels, or not rather to use, but for the negative levels to provide or to function as significant support levels, we actually need to see price retrace up to at least 50 to 61.8%, right? Do take note, price must retrace, right, after forming this low here, this significant swing low here. Price must retrace to at least 50% or even better 61.8%, so that when we see a market structure like this, and then should price reverse and drop lower, breaking under the 0% or the ending point, that means that these negative levels are expansion levels at negative 27.2 and negative 61.8% Fibonacci are going to potentially function as significant support levels, right? So do take note, this is another key aspect when using the expansion levels. The Fibonacci, the market structure must retrace up to 50 to 61.8%. It must, right? So at least 50%, and then should price reverse and drop lower, breaking under the ending point, that means negative 27.2 and negative 61.8 are going to potentially function as significant support levels, okay? This is a very important aspect, because if price only retraces up to 38.2% and then stalls and reverses to drop lower, that means this levels here at negative 27, negative 61 may not offer significant support, right? Do take note. This is one key criteria, right? The key criteria is the retracement has to come up to at least 50%, right? The retracement has to come up to at least 50%. I'm talking about this retracement here, right? It has to retrace up to at least 50%, even better if it comes all the way up to 61.8. And then as it reverses to drop lower, the expansion levels are then likely to function as significant support. All right. Okay. Now, in this example, we can see clearly that price has retraced to 50 and has even reached 61.8%, right? And then has now started to reverse and drop lower. Now, so how can we use these expansion levels? First off, as price starts to retrace to drop lower, we can also use the 0%, for example, as a potential take profit level, right? So if you go short on this position here and price is reversing, right? Perhaps there's a strong bearish catalyst that has a combination of a strong bearish catalyst, and your technical analysis is telling you this is now a potential short entry, where you would identify your take profit would be potentially here at the major swing low here at 0%. And should price continue to break lower, you can identify your second TP or take profit at the negative 27.2%. So, right, this is where we can this is how we can use the negative Fibonacci levels or the expansion levels to help us identify potential take profit levels for the short side, right? So in this example, you're seeing it for the short side, for a potential short trade, right? So typically, um, in this scenario, price will, if price breaks below this swing low here, it will typically find support at negative 27.2%, And usually it does bounce off this level to return to 0%. So do take note. So this is how we can use the negative 27.2% Fibonacci expansion level to help us identify a potential take profit on the short side, or for the potential short trade, right? Okay. With that, okay, now we're going to look at Fibonacci levels that are greater than 100%, right? The key Fibonacci levels that are greater than that are greater than 100%, as I mentioned earlier, at 161.8 and also at 127.2%, right? These are the two key significant retracement levels. Sorry, extent levels that are greater than 100, and these levels that are greater than 100, they're also known as Fibonacci extensions. All right, do take note. Right, so if you come across the term Fibonacci extension levels, it is simply referring to levels that are greater than 100%, and they're specifically referring to 127.2% and 161.8%, right? Just like for the Fibonacci expansion levels. So similarly, if you come across the term Fibonacci expansion levels, they're referring to levels that are the negative levels, and specifically referring to negative 37.2 and negative 61.8. Okay, so expansion levels are negative, also known as the negative Fibonacci levels, also known as Fibonacci expansion levels. And the Fibonacci levels that are greater than 100% are also known as the extension levels. And the key extension levels come in at 127.2 and 161.8%. All right, so in this example here, right, we see price from this starting point here, point 1 making the swing high here, and then point 2 has made the swing low here. So how we can use the extension levels is we can use these extension levels to help us identify the take profit, a potential take profit identity zones. Sorry. So in this case, you can see price has made this Nike tick structure. You can see this Nike tick structure, right? We all know the company Nike and its logo, which is the tick. And you can also clearly see a price. This market structure here is following this Nike tick structure. So what we see is, or how we can use the extension levels, is when we see price reverse strongly and come back up to the starting point, which is at 100%. Here we can say we're looking for potential bullish breakout here, right? We have our technical indicators telling us that this is a strong bullish move. We also have a strong fundamental data catalyst that's driving this move as well. So we are looking for potential bullish breakout. So when price breaks above 100% here, how we can use the extension levels is we can use them to identify potential take profit. So for example, 161 here has been identified here, and 127 is probably somewhere around here. So we can use these extension levels to identify potential take profit. So this could be the second take profit zone, whereas the 127.2% would be the first take profit zone, right? So this is how we can use the extension levels to help us identify potential take profit zones should price break above the 100% or the starting point and continue to drive higher. And then from here is where you could potentially is to identify a major resistance level. And from here, you could also potentially initiate a short trade idea as well. Because when you see price failing to break above the 161.8% extension level, it is quite likely it is going to drop lower. So as price moves away from this extension level and starts to drop lower, you can initiate a short entry, and your stop loss will be placed slightly above the 161.8% Fibonacci retracement to give us a little bit of a buffer, right? To give us a little buffer. So should price retrace back to the 161% as you can see here, but because we've kept our stop loss slightly above the extension level at 161%, it allows us to remain in the trade, and should price continue to drop lower, we can benefit from this potential short trade idea as well. So you can see how the extension levels can be used to identify potential take profit zones to the upside. And then once it hits 161.8% Fibonacci retracement extension, and then it starts to pull away, you can also consider initiating a short trade idea where you put the stop loss slightly above the 161.8% Fibonacci extension. All right. Okay, great. Let's see. Right, okay. Um, we've come to the end in terms of my slides. So what are we going to do? What we are going to do now is we are going to move over to trading view and try and find examples of how to use the Fibonacci retracement tool correctly, right? So we're going to start, of course, just start off with the basics. All right. Okay. So here I am on trading view. I'm on the 4-hour time frame, and I'm going to use the dollar index as an example. Right. So first of all, we're going to try and identify significant swing highs and swing lows. So let's just do this exercise together, right? So just to take note, when we are using Fibonacci retracement tools, they generally work better on the higher time frames, right? So they generally work better on the 1 hour time frame and above, right? You can use them on the lower time frames as well, 30 minutes, 15 minutes, but they may not offer the same level of support or resistances as when we use them on the higher time frames. So do take note uh, about this aspect of using Fibonacci retracements, right? They do tend to work better on the higher time frames, such as 1 hour and above. All right. Okay, so first of all, we do a simple exercise on trying to identify significant swings, right? As we saw in the slides earlier, right? We saw examples of insignificant swings, and now we're going to look at examples of significant swings. So this is I'm on a 4 hour time frame for the dollar index, DXY. My chart is showing the price structure from end of September all the way to present time. So I think it's quite clear by now where the significant swing lows and swing highs, right? So, right, you can see here this is a significant swing low here. Okay, maybe hang on. Right, let's start off with swing highs. We can see this is a significant swing high. This is also another significant swing high here. This is another significant swing high. This is another high. This as well. This as well here, right? So 1, 2, 3, 4, 5, 6, right? These are generally how we would identify significant swing highs, as this one here as well. So the red circles are, I'm highlighting the significant swing highs in red. And now I'm going to highlight the significant swing lows in green. So you can see here, this is a significant swing low. This is another swing low here as well. Here, 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 and of course here, right? So what we're actually trying to look for, right, is I'm going to now just use a different color. So we're going to look for significant swings, right? So you can see when price makes a very strong V-shaped move here like this, as highlighted in the orange line, right? You can see that this is a very significant V-shaped move, right? And this tells us this is a significant swing low, and this is a significant move. Similarly, right, when I draw the swing high from here, we can see this is an inverted V shape, right? We can see a very clear, significant swing high with a strong inverted V shape as well. Similarly, for this downside, we see a strong V shape here. And then for this swing high here, we can see generally the pattern I'm trying to get at. You can see that this is another inverted V. Similarly here, this is a strong V shape pattern here, swing, another strong inverted V shape here, another strong inverted V shape here, strong V-shaped pattern here to signify the significant swing low. Another one here, inverted V-shape to indicate the swing high. Another strong V-shaped pattern here to indicate the swing low. And this high here, low here, high here as well. This is also a pretty significant swing low bounce here. And of course, this significant swing low over here. Right, so you can clearly see how we can identify major swing highs and swing lows, right? That's important, right? So as you can see here, I'm just going to leave this on for a bit before I erase it. So you can clearly see the green circles highlighting the significant swing lows, whereas the red circles are highlighting the significant swing highs. And you can see by my orange V shapes as well. We see an inverted V shape as well as the regular V shape that show us the size of the move, right? We're looking for significant swings and lows and highs, and the size of the move can be is highlighted by my orange brushes, right? You can see that the moves are very significant. So this is how we identify swing highs and swing lows, so that we are able to identify ideal starting and ending points for the Fibonacci retracement, right? Okay, so now I'm going to clear all of this, and I'm going to show you how we can draw the Fibonacci retracement for these on these swing highs and swing lows. All right, so we'll start with here on 29th of September and we'll end here on 3rd of October. Okay, so for those who may not be familiar with the Fibonacci retracement tool, the icon looks something like this, right? So you'll see 4 lines and you'll have the bubble here as well, the circle here on the left and on the right. So if you highlight it, it'll show you depending on whatever platform you're using. But if you're using a trading view, right, if you highlight over this icon here, it'll tell you Fibonacci retracement. So that's what you want to use. So we click on that, and we're going to start with the absolute low point here. Okay. So I'm just going to zoom in a little bit. Right. So I'm going to just zoom in a little bit. So this is my starting point, right? So remember, for this is an uptrend. So Fibonacci retracement always goes from left to right. Since this is an uptrend, we're going to start from the bottom left and we'll end at the top right. Okay, I'm going to pull up all the Fibonacci levels here. So this gives me the negative levels, the positive levels. Remember, negative levels are called expansion levels, and levels greater than 100 are called extension levels. Okay, right. Okay, but with that, I'm just going to focus on the retracement levels in this example, right? So as not to overcomplicate things. So I'm going to get rid of the extension levels as well as the expansion levels, right? And we're just going to deal with the retracement levels going from 0 to 100%, right? So then this is much more clear. So when we draw the Fibonacci retracement from this uptrend here, bottom left to top right, and as price is coming down, these retracement levels are going to potentially are going to highlight potential support levels, right? Now, whether these levels truly function as significant support levels, we can only tell when the move plays out. But generally, it does help us to identify potential support areas. So as price has made this swing high here and started to come down, we can see that price did find decent support at a 23.6%, retracing higher before falling lower. Then again, you can see here, it did find a little briefly found support here at 38.2%, again at 50, then also pretty strong support here, 61.8%, 78, and then finally 100 down here, right? So you can see clearly in this example here, price did seem to find support at almost nearly every single retracement level. Now, this doesn't always happen to be the case, right? There, as we saw in the slides, right, there can be cases where price will just simply break through the 23, 38, maybe even the 50, and then find support at the 61.8%. So do take note, in this example here, we do see price to have clearly found support at each of the retracement levels, right? Okay, this was an example for the uptrend. Now I'm going to draw a Fibonacci retracement for the downtrend, right? So this was the uptrend, bottom left to top right. We can clearly see here, this is a strong move down. We have a nice significant swing high here on 3rd of October, and we have a significant swing low here on the 12th of October, right? So we're going to start this retracement from here. Remember, whether it's a uptrend or downtrend, we always go from left to right. So since this is a downtrend, we'll start from, hang on. We'll start from the top left and we'll end down here on the bottom right. So in this example, we can clearly see price has broken through 23, 38, and 50% very easily, right? Very easily. These retracement levels here did not offer a hint of resistance at all. Where it did finally run into resistance was at 61.8%, right? And then after that, over the next half a day or so, price briefly broke above the 61.8 as well before dropping lower. So you can see where price found major resistance in this example is at the 61.8%. Do remember over here when we did the Fibonacci retracement on this uptrend here, we could see price finding support at every single retracement level. However, for this part of the move, we can see where the the only level that offered serious resistance was at the 61.8% Fibonacci, right? So you can clearly see no two Fibonacci retracement is going to behave the same way, right? We are never going to see the same retracement levels functioning as a major support or resistance, right? Every uh, swing high and swing low, or every uptrend and downtrend is going to be different, right? So do take note of that. There's nothing set in stone with regards to the Fibonacci retracement levels. It could be a case where the retracement levels offer support or resistance at every single level, or there could be a case like what we're currently seeing, where only the 61.8% has offered significant resistance. All right. Okay. So here we can see the price running into resistance 61.8 on 12th of October, 13th of October, as well as 19th of October, right? Okay, so these were the two examples of how we can use how we can draw the Fibonacci retracement for an uptrend and downtrend. All right. Okay. Now let's move over to somewhere to where price is currently trading. Right. Let's see where price is currently trading and perform some technical analysis here using the Fibonacci retracements. All right. Okay. So once again, before we try and draw the retracements, let's do a simple exercise where we can try and identify the significant swings, right? Okay, so this is a green. All right. So we can see here, this is a pretty significant swing low here on 29th of November. Another significant swing low here on 15th of December. This significant swing low here on 28th of December. So when we look at end November till now, we can see three significant swing lows when we're on the 4-hour time frame. All right. Okay, now I'm going to try and identify significant swing highs. Right. You can see here, this portion here is a pretty significant swing high here. And over here, okay, price has not yet played out, but you can generally see the top of this wick is another significant swing high as well. Right. Okay, so let's just say, okay, let me just okay, I'm just gonna highlight my points so it's easy to refer to as well. All right, so let's work with points 1, 2, and 3 first. All right, let's work with the first 3 points. All right, so we have identified our major swing highs and swing lows. So let's just focus on the first 3 points. So for this upward trend here, we would be actually technically we would have highlighted this as 0.2 because as price was pulling down, we have highlighted this as 0.2. So we'll take this in step by step. So we'll start the retracement for this uptrend here from 0.1 to 0.2, right? You can see here in this example, as price was pulling back, 23.6% did not offer any support at all. 38.2 not really, because we can see the wick extending way beyond the 38.2 and even dipping below the 50%. So where it did find support here in this example was around the 50% Fibonacci retracement, right? As we can see here, the body of the candles actually closing underneath the 38.2%. And we can also clearly see the wick extending beyond the 50. So where price did find support in this example was at 50% before going higher. And as price comes up here, right? When a new high is made, we cannot use point two, the original point two anymore. If we do wish to use the Fibonacci retracement, we have to move our ending point now because this is a new high. We have to move it to here, which is, yeah. And in this sense, you can see the trend line, right, is capturing the market structure quite well, right? Is not as ideal, as perfect as what we saw here at the first go. You can clearly see the trend line has captured the market structure very well. But even when it makes this second high here, you can see that the trend line has captured the market structure quite well. So we can still use this. So similarly here, 23.6% did not offer any support. Where it did find support was this time round at around the 38.2 before retracing higher and then finally smashing through all the other levels. You can clearly see here as it smashed through 38.2, 50%, 61% offered no support. Where it did find support briefly was at around the 78.6% Fibonacci retracement. All right, you can clearly see how the retracement levels help us to identify potential, right? The key word here is potential support levels or potential resistance levels, right? Nothing is set in stone. It doesn't mean price has to react off each level, but it's just helping us to identify potential support or resistance levels. Okay. Now, after price has come down here, it has found support around 100 and 190 before proceeding higher. So now we have 0.2 and 0.3. We can also run a Fibonacci retracement on this downturn. So we'll start from here, 0.2, 11th of December, going down to 0.3, which is the 14th of December. So in this case here, we can see as price was retracing higher, these retracement levels are helping us to identify potential resistance areas or zones, but we can clearly see 23.6% offered no resistance. Where it did run into resistance was around the 38.2%, right? 38.2% was where price found resistance before dropping lower. And you could see from 18th December all the way till 3rd of Jan, right? This price failed to break above this level until just recently last week. Okay, so this is how we can use the levels here. Now, as price comes down here, right, we can see now this, I would use this as let me highlight this as 0.4, right? So you can see here, this is a pretty significant swing high. This is a significant swing low. So if I were to extend this Fibonacci retracement, right, I go from 2 to 4, right, we can see that the market structure, the trend line has captured the market structure quite well, right? Quite well. Some would argue that because this has drifted too far, I would not use 0.2 as a starting point, but rather I would try and use 0.3 here, for example, this point here. Okay, here the market structure, the trend line captures the market structure a little bit better, but even here, I think to me, this is still pretty all right, right? This is still pretty all right here. You can see at this part, especially the beginning of the move, the trend line captures the market structure very well. And the second half of the move, it captures it pretty well as well. It's only this bit here. So as price is retracing higher, we can see clearly 23.6, 38.2, and 50% retracement levels offered no resistance at all. Where it did run into resistance was around the 61.8% Fibonacci retracement, right? So you can see here, these retracement levels are just going to help us identify potential resistance, but you actually have to see where price is actually going to run into, right? So you can see here, because this is also an overlap, a pretty strong resistance level here, right? As price retrace higher here in 18 December, this forms a pullback resistance, right? This forms a pullback resistance level. And you can see price actually running into resistance here on 3rd of Jan, right? It broke above 23, 38, and 50 very easily, but it actually stalled at around this resistance level here at 102.64. And also we can see how the 61.8% Fibonacci retracement has also helped us to identify another strong resistance zone above this pullback resistance. Okay. And now, okay, I'm going to label this as 0.5. So in this case, I'm going to run the Fibonacci retracement from 0.4, this swing low, ending with this high here at 0.5. Now, as price is, let me get rid of this. Right, now as price climbed as high as or briefly going above 103 and then pulling back sharply, you can see that as it was falling down, 23.6% offered no resistance. 38.2 is a level where we did find a little bit of resistance, right? But actually, you can see it actually go beyond. So where it found support, where it found support was slightly above 50%, right? So the major support for the dollar index now is actually at around 102.10. And we can also see that 50% is also still suggesting another strong support zone should price break underneath 102.10, right? So do take note, these are the key support and resistance levels of course, now with price breaking above it, I would have to adjust my resistance to this level here. I'm going to use the body of the candle so we can see the major resistance at 102.74 and major support at 102.10. All right. So so we've covered Fibonacci retracements today, which is part one of the Fibonacci series, masterclass series. Right. So do look out for part two coming up next week, right? So where we will be building on retracements, right? We covered a little bit of extensions and Fibonacci expansions today as well. Do take note, expansions are the negative levels and extensions are the levels greater than 100. We covered a little bit of that as well. And in part two, we're going to delve a little bit more deeper into them. All right. So just to recap, today we had Fibonacci retracements. Do remember we're looking out for significant swing highs and swing lows, right? Such as these, right? We're looking out for significant swing highs and lows. Where did it go? Where's my brush? Right. Such as these, right? This is a significant swing low. This is a significant swing high. Another significant swing low. Also another significant swing low and swing high. So do take note. It is important to identify a good or ideal market structure where we can clearly see the significant swing lows and the significant swing highs, so that when we draw the Fibonacci retracement tool, we're actually going to get uh, uh, indication that these retracement levels are going to offer uh, significant support or resistance. And do take note that the trend line has to capture the market structure as closely as possible. All right. Okay. So we've come to the end of today's webinar. Thank you all for tuning in. Do look out for next week's uh, Fibonacci series part 2, right? And do register for that as well. All right. Take care. Have a great trading week and enjoy your weekend as well. All right. Thank you, everyone. And I'll see you guys next week. All right. Take care.